Hello everyone. In this introductory video, I will be dealing with the basic understanding of what exactly is a cycle tree all about, why it is there in the market, why it would recur regularly, and how we would want to use it as a wealth creating opportunity. Such a knowledge base is really a prerequisite requirement before moving to educational articles that you will get to see on the site. Before we move on, would want to draw specific attention to announcements and our trade and risk disclaimers. Excuse me. Specifically, of course, the high risk investment warning and the trader psychology. Whenever you see these, please freeze the station or freeze the video, or read them very carefully, pay very close attention to them because they're instrumental to our trading well-being. Let's now move on to what exactly a cycle 3 is. We'll start with trend classification, the duration of trends, and realistic target projections that we could get out of such moves. We'd first need to understand the dynamics behind a cycle 3. The dynamics behind the cycle 3 really have to do with trading CFD contracts. CFD are contracts for difference. This is the instrument that we are trading. All right. The dynamics behind trading CFD contracts are simply that all market participants are trading a specific supply-demand cycle. They are buying and selling within that cycle range. Businesses would want to hedge the foreign currency transactions to fix the production and operation costs. This means that if you were trading, or such businesses were, and manufacturing is trading inside of this trading cycle, suppose there is a sudden increase or decrease in price levels, they can only safeguard or control pricing, which will directly affect the production by having sell stops below the cycle support or the perceived cycle support, and buy stops above the perceived cycle supports. Now, speculators in highly liquid FX markets will push order flows below and into such open hedge sell interest on release of micro fundamentals that trigger a bearish outlook for the currency. This is not really done intentionally. It is just the function of markets. If you have a micro fundamental released and it is perceived in bearish sentiment by the market participants, they will of course sell into the market aggressively, and this will trigger all the sell stops beneath specific cycle support. The move that does result out of this, or the resulting slide, is a very rapid one and really is a wealth creation opportunity. The market, it would usually take 2 days for the market to stabilize after such a move, sometimes even longer. In our example here, we're showing that such moves can last for 6 days, can last for 8 and 10 days. We will all get to see such moves recur regularly in the FX market. You find that the market regularly is just doing in a consolidation phase and suddenly breaks out either to the upside or to the downside. This is of course usually pending a micro fundamental or an intermediate term fundamental. The fact is that when it does occur, we don't want to be caught off guards. We don't want to be surprised. We want to be now prepared and to use such slides or breakouts in an efficient profit generating manner. Now let's move on to how we're going to detect that such market action could occur or is actually occurring on the markets that we are going to be trading. There are two conditions to fulfill. All right. So the first of these is that the CCI gradient must be continually trending. In this example that we're looking at, we're looking, of course, at a bear trend. So the CCI gradient must be continually trending down. When we are saying that the CCI gradient would be continuously trending down, it means that if I'm doing a measure of the CCI reading on a daily basis, I must be getting lower CCI readings every day during the duration of that cycle 3 trend. It is no problem if other traders would prefer to use other oscillators than the CCI. We are, of course, doing extensive studies on the CCI, so the important factor here is to truly understand the oscillator that one is using. The second condition that would have to be fulfilled is recognition of the cycle wavelengths and amplitude, or the cycle periodicity. So if we have a breakout of a specific cycle, we're having here a number of support resistance sine wave cycles. If we have a breakout of any of these cycles, we must be able to relate that breakout to the cycle out of which the market has broken out of. This is essential because usually when impacted by a macro or a micro or even an intermediate term fundamental, the cycle will simply do an equal measure of the cycle amplitude and then simply recur. Meaning the same cycle would recur over and over again, just at a new different level, and that different level is simply an equal measure of the cycle amplitude. All right, so of course, if we are going to be recognizing that there is a trade opportunity, we need to recognize the cycle out of which the market has broken out of to relate to the fact that we're going to be doing a target equal to the cycle amplitude out of which the market had made the breakout. And that usually, as a protective stop measure, we will just need a stop measure at least half the size of the cycle amplitude, theoretically speaking, at least. All right, so condition B must be satisfied. We must all relate the market action to the cycle periodicity. All right, this is the cycle wavelengths and its amplitude. In this example here, we can find that there is a recurring cycle every 2 months, sometimes a bit longer, but the cycle does recur every 2 months. It would mean that this is usually impacted by an intermediate term fundamental, maybe like the Federal Reserve raising rates during the meetings, as an example. The important take here is that if we're doing the trade, we know that the full cycle duration is a 2 months duration, and we should not expect to collect all our yields or collect our projected yields, all right, except on a quarter annual basis. The quarter annual basis here does not relate from the time that our trade has been triggered, but really does relate from the time that cycle went into effect, as shown here, and also would relate to the preparation phases of the trade itself. We will be dealing with this in more detail as we move on to other slides. All right, and the next dynamic in a cycle 3 that we want to look at are the projected targets. We already related this on the past slide. Usually, if we have identified a cycle, like here, we can see there's a strong, extensive downtrending cycle. If we are going to be selling, once we can detect there is continuous decrease in the CCI gradient, we could, for instance, sell by sell stop once we are able to detect such continual decrease in the CCI momentum. Our target level is now simply an equal measure of the cycle amplitude out of which the market has broken out of. All right, let's now do a complete position trade using such information regarding cycle 3s and the recurrence. Remember, we're going to be seeing this several times all right, recurring on the market. We're going to be seeing such breakouts. And usually they go to waste because we do not implement a correct specific strategy to optimize on such opportunities. Many traders are simply caught off guard on the breakout, and we're not really expecting it at such a time. Okay, so this is a simple position trading technique. In this video, we will only be dealing with position trading and swing trading. In the next video, we'll be dealing with short-term trades. So this is usually a position trading technique. All right. First, as a position trader, your target, or as position traders, our targets would be to create yields out of specific longer held positions. The duration here is about 1 quarter, one annual quarter, as shown here by that cycle projection. We would first want to confirm that the market is trending in cycle 3 momentum. The market, of course, is trending in cycle 3 momentum once you have momentum that is usually, or always, most of the time at least, below overbought levels, such as shown here. This kind of strategy is really investing regularly in a secular trend. And of course, it's a position trading strategy. The next condition to fulfill would be to estimate the trade cycle duration. If you're going to be doing a trade, of course, you want to know in advance when you are going to be able to collect yields. All right, so the trade cycle duration is usually the higher degree cycle that we are going to be trading on breakout of the internal or the current lower degree cycle that is currently impacting the market. In these examples shown here, we can see that usually the lower degree cycle that had been impacting the market would be a half wavelength measure of the higher degree cycle on breakout, right? We are, of course, doing an equal measure of the lower degree cycle, and the trade cycle duration is estimated as the complete measure of both cycles together. Why is this necessary? It is necessary because if you're joining the market fresh and the cycle is already in play, it doesn't have to be that you are starting at the beginning of the cycle. It doesn't have to be, you could be going to be doing your entries midpoint in the cycle on specific technical triggers. Wherever any of us is going to be joining the market, we really need to relate to the cycle length. How long will it take for us to be profitable? All right, and in which mature stage of the cycle are we in, and when to expect breakout. The third condition that we need to fulfill would to begin accumulating short-term entries. All right, in this case, this is of course a bear trend, so we would begin to accumulate short-term entries at past monthly broken supports. So if we are able now to identify the cycles, it simply becomes more efficient not to buy on a breakout, also not to sell on a breakout, but to sell at the cycle high or close to the cycle high as possible. Remember, I was just saying you could enter the market midway in the local cycle projections. You could, of course, we would, of course, all of us project internal corrections, how far they could go towards attacking the old or the past monthly broken support, accumulate shorts at that level. All right. And if you know the cycle duration is going to be 2 months, then we would probably know the remaining cycle projected period, and we would hold the trade for that duration. So let's just simplify to 1 quarter, one annual quarter, at the end of which we should be able to take profits. This is a step 4 here. Take profits at a projection equal to the measure of the support resistance cycle amplitude. We would take then profits equal to an equal measure of the past cycle out of which the market had broken out. All right. or take profit simply every annual quarter on a specific periodical basis. In this case, this is a position trade at the end of every quarter or every annual quarter. The target projections are shown here. So the ultimate yields measured from the top or close to the top of the previous cycle before breakout, all the way down to a projected one-to-one measure, all right, below the cycle bottom is about 600 points. In this first example, 800 points. And this second example, 700 points. In the third example, over a 1 quarter period. This means that if we are able to recognize a cycle 3 secular trend in any issue, and for example, we are going to be selling one contract or parking one contract into that trend. Long-term selling would be termed as investing, or parking a part of your specific percentage of your account into such a move. So if we are going to be parking, say, one contract over a 2-month period, by the end of the 2 months, it should generate $6,000. If you're doing 600 points in this move per mini, then of course per standard contract it's going to be $6,000. Suppose we will be parking 1.5 standard contracts, it becomes $9,000. And this second example, suppose we park 1.5 contracts, it becomes $12,000 because the profit range here is 800 points. In this third example, suppose we park 2 contracts, for instance, it becomes $14,000. So it's like a fixed income investment, whereas the period or the time at which you're going to be holding the investment and the yield, the projected yield at the end of that duration. Let's move on now to identifying trend volatility. Trend volatility here is simply identifying if the current cycle 3 breakout is a wave 3 or a 4. Is a wave 3 or a wave 5. Ellioticians, or those of us who are familiar with an Elliott structure or Elliott waves, can relate to the fact that the market moves in 5 waves. The motive ones are wave 3 and wave 5, with wave 4 wedged in between as a corrective wave. Wave 3, of course, is a very strong wave, and it's more volatile, would reach higher target projections. Wave 5 is really a market consolidation in a bull or a bear trend. It is bullishly or bearishly tilted or translated, but it is of less volatility and longer time duration. So we would want to always differentiate between both, so we are applying the right strategy. Both are tradable within a cycle 3. A wave 3 gets traded as a position trade usually, and a wave 5 gets traded as a swing trade. Usually swing traders are trading wave 5 breakouts, even if they do not classify them in so many words. All right, let's take a look at let's take a look at wave 5 dynamics. We're looking at the sterling dollar example. You can see, of course, that the market is trending down. The important focus here is the momentum, right? So momentum always gets contained at and below minus 100. This is, of course, a bear trend. So we're relating to oversold levels, OS. And this defines wave 5. Again, when momentum is contained at and below minus 100, it's shown here. It is still trending bearish, but of lesser intensity, and this is qualified as a wave 5. Let's compare this with a wave 3. This is the past example that we're looking at a while back. Over here, daily momentum mostly is trending below minus 100, oversold, and this really is a wave 3. You can find momentum is very aggressively trending below oversold, and this really classifies a wave 3. So this is the basic difference, can be easily confirmed by the momentum histogram plot. Sorry again, by the momentum histogram plot. We're using, of course, the CCI 100, right? So let's move on now to cycle 3 dynamics. Sorry, cycle 5 dynamics, how to identify them so that we are able to trade that trend. Identifying, of course, a cycle 5 has really two conditions, very primary and important conditions. They're very primary and important because they set our vision to the market correctly. They really get us correctly or oriented in the right direction without too much hassle or trials. So there are two conditions. The first is to identify momentum on contained at overbought levels. At this point, it's minus 100 overpoint levels, would mean that this is a wave 4 and that if you're seeing momentum contained in a bear trend above minus 100 overbought levels, you should be seeing a local head and shoulder cycle on the 1 and 4 hour time frames. So let's take a look at this more detailed. We can see here that momentum is contained above overbought. This is called the cycle 4. You can see here at that red arrow that again momentum is contained at overbought. This is another cycle 4, and this is the third cycle 4. Whenever momentum drops, the histogram drops below oversold, it becomes a cycle 5 actually. It becomes trending, like this move here. So whenever you have a cycle 4, you should be seeing some kind of head and shoulders, all right, on price. These, of course, show much stronger on the 1 and 4 hour time frames. So a cycle 4 would mean local head and shoulder cycles on the 1 and 4 hour time frames. If we do not have this classification, all right, it would actually, some of us would consider that there is a breakout higher, or any of us could consider that there is a breakout higher because there's a bounce in the market at that point. There appears to be a supporting ledge and you are just doing a consolidation. So why not break out higher? Why not break out higher is because the momentum is negative on the daily chart and it is doing a cycle 4 and a cycle 5 shown here. And these are simple cycle 5 dynamics. The market will keep switching between cycle 4 and cycle 5 to break down into a bearish cycle 5 in this case. So there's no point in buying into it. It does immediately put us traders in the right direction, so long as we have a cycle 5 dynamic classification on the daily CCI momentum, which is showing very clearly here. So this is condition A. Condition B simply identifies the breakout point by relating it to the 1 hour and 15-minute charts. So we can, if we're seeing a very local head and shoulders at this zone, breakout to the downside gets confirmed, we get to identify breakout from this local head and shoulders by using the 1 hour time frame through eruption of cycle 3 bearish momentum on the 1 and 15-minute charts. We know at that point that we are at the right level because we are confirmed that momentum is a cycle 4, bearish cycle 4 on the daily chart. So taking a trigger on such short-term simple momentum plots like the 1 hour and the 15-minute chart is the correct measure to do. All right, will put us into a breakdown of a cycle 5, will probably endure for 4 days. All right, and at the end of this period, we should be able to collect yields or profits. Let's now move on to actual trade implementation and how we would measure the trades. Right, so you need again to identify the wavelengths of a wave size of the wavelengths of a cycle 5 or a wave 5. All right, in this example we are using the cycle highs to really identify wavelengths, and you'll find that breakdown occurs on a monthly basis as shown here. Okay, so we are able, if we're going to be trading that cycle, we are really trading the internal head and support. All right, so it of course shows us a very minor move on the daily chart. That's why on the daily chart, the cycle swing is really between the cycle highs in this case. But we could still identify that we are able to do a swing trade on a monthly basis. So the cycle periodicity is again very important, just like with a cycle 3. All right, in this case, it is clearly identifiable that it's a monthly trade. All right. The trigger now, also these internal head and shoulders, becomes a breakout from local head and shoulders on the 1 hour frame through eruption of cycle 3 momentum on the 1 hour and the 15-minute chart. Let's take a look at the targets. So if we take these targets on a monthly basis, as shown here every month, usually on the daily time frame, the cycle would do a very strong extension. It's really a cycle 5, but it becomes a cycle 3 inside of a cycle 5, a local internal cycle 3. And because the consolidation is very compact, remember that technically speaking, the longer there is a consolidation, the more compact it is, like using tightened Bollinger Bands, the stronger the breakout, related of course to that consolidation. So the target projection is usually 261.8%. All right. This measure is taken out of a 1 hour or a 4 hour chart. This is the short-term cycle 3 that we'll find we are usually trading if it is not a secular trend. All right, or it doesn't really it could be a secular trend, but it may not erupt into a secular trend. Okay, so this is usually the classic short-term, again, cycle 3 that we usually trade, taking a 1 and a 4 hour trigger. Why is this more tradable than a secular cycle 3? It is because the market, of course, is consolidating between a wave 4 and a 5 70% of the time. So on a monthly basis, you will always get several issues that are doing a cycle 5 dynamic, whereas on an annual basis, on a yearly basis, we were just looking at that euro dollar example. This is a secular trend that occurs once a year. Yes, we can invest into it regularly throughout the year, but we just allocate, say, 10% of our account to trade it on a quarter basis, right, throughout the year until it does end. In this case here, or in this example here, this is really swing trading example. This is a swing trading strategy. We can get to trade it on a monthly basis if we identify it right and if we are not caught on the wrong direction. We just showed how we will not or should not be caught on the wrong direction by simply identifying that this market is moving between a cycle 4 and a cycle 3 because of the momentum plot here showing a cycle 5 dynamic. So it's more frequent to trade, necessary to be able to trade it correctly so that our swing trade abilities drastically improve. Finally, we need to be able to confirm when a cycle 5 has broken out into a continuous cycle 3. Usually a cycle 3, an extending cycle 3, will do internal cycle 4s and then breaks out into a cycle 5. On this same example here, the sterling dollar, we are looking now at the cycle 3 and cycle 5 dynamics. Remember that the market was continuously flipping between a cycle 3 and a cycle 4 in the past example here. We were looking at cycle 4 and 5 on momentum that is continuously flipping between 4 and 5. At some point, the market will continue on its downtrend or on the secular trend, and we are flipping between a cycle 3 into a cycle 5. So you must be able to recognize cycle 3 extensions. There are again two conditions to fulfill. The first is to make sure that there is always, this is of course a bear trend, and we were just saying how could you tell that this consolidation is going to break out higher? It is because a cycle 4 is impacting the CCI on the daily chart. So condition 2 here, or the first condition, if you wish to call it that, must be failure to break above the zero line. All right. If on the daily CCI, if you expect continuation in a cycle 5, because this was doing a cycle 4 and you expect it to break out into a cycle 5. So if you really expect continuation into a cycle 5, we must always regularly have failure to break above 0, all right, on the daily CCI. This is clearly showing here at that at B and B. The primary condition, of course, is if you are going to be trading a cycle 5 to confirm that the positive momentum that you get to see on the 1 and 4 hour charts, because at these market highs here, this is the market top, we all will be seeing positive momentum on the 1 and 4 hour time frames, is not a cycle 3 positive reversal. It cannot be a cycle 3 positive reversal because, again, the CCI momentum on this daily chart is negative, is actually classified as a cycle 4 going into a cycle 5. So it cannot be a breakout, all right, unless we have resurgence of positive momentum on the daily chart. All right, at some point there is going to be resurgence of degree 3 negative momentum here and cycle 3, just like what had happened here before. Of course, the wave 3 simply means that momentum after doing internal tests of a wave 4 breaks lower into continuation of a wave 3, breaks below oversold, and then we can tell that there is a new motive, cycle 3, which could be termed, of course, as a wave 3 or a wave 5. At that point, all elutitions can simply label the correction. It would have confirmed that we have been doing an internal wave 3 inside of, or some kind of a label inside of that high degree wave 3. There had been an A and a B and a C, as shown here, and that the market had broken lower into a 5 or an extension of a 3. So we need to relate and understand the dynamics of the market moving between 3 and 5 in a simple manner, in a very simple manner, because for trading purposes, too much analysis would cause confusion and paralysis, of course, and traders really need to be focused on the market dynamic moves in order to be able to reap the most benefit of such moves. If we are able to classify and identify the differences between different momentum cycles showing on the CCI as a 3, a very intensive move, a 5, a dormant but trending move, and a 4, the corrective move in between that will ultimately break lower into a 5 and not reverse. I believe we can then now move on to actual implementation, pragmatic trading implementation that you will find on our educational articles. Right, so the best of luck for everyone. In our next video, we are going to be looking at the different trading strategies, short-term now trading strategies that we can implement inside of a wave 3 or a cycle 3, a cycle 4, and a cycle 5. See you there. Good day.